Hey, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And last week, we had a pretty significant shift in terms of overall tone towards the end of last week as the FOMC meeting concluded and Chairman Powell it reiterated that he was not likely going to have to raise rates, and taking that option off the table led the markets to rally as a result of that towards into the end of last week and into the beginning of this week. And we'll take a look at kind of where overall equity markets stand. The picture has improved, I would say, since the time that we had met about 2 weeks ago. The S&P 500, as you can see from my chart here, after breaking down below the 50-day moving average, as of yesterday, has managed to claim back the 50-day moving average. We've basically concluded a big rally here from the 6-month rally from about 4,100 up to that 5,250 level. After correcting that roughly 5% or so, we've managed to break back above we break back above the 50-day moving average. And we see this on both the S&P 500 as well as the NASDAQ 100. We've rallied up to that 450 level on the Qs, broke below the 50-day moving average, but just yesterday we managed to get back above the 50-day moving average. And we see the same thing here on IWM, the small cap ETF. Now, despite the fact that all three indices have broken back above the 50-day moving average, we're still below the recent all-time highs on all three. And until we get back into that level and break out above that level, I would say that our overall tone here for the markets remain more neutral than, I would say, outright bullish. But we are seeing, some overall bullishness here to the current market at the moment. So this is something to pay attention to here right now, and we'll take a look at some of the other indicators as well to help us understand kind of our overall outlook for the overall outlook based on some of the other indicators. But that's the thing to really keep in mind right now with regards to equities, is that we've seen an improvement here, but things aren't quite 100% back into what I would say bullish mode. We see part of this in terms of the equal weight indices. We see the fact that the equal weight indices have not broken back above the 50-day moving average, meaning the rally that we've seen here over the past couple of days is not particularly broad. It's actually fairly narrow. And as you can see, the relative performance here of the equal weight index relative to the market cap index is actually quite poor. So, that's some of the concerns that I have with kind of the health of the current market rally. And we'll kind of take a look at some of the indicators to give us a better sense for where this rally is coming from. So over the last year, growth has continued to outperform value, but over the past 3 months or so, we really started to see value show a little bit of strength here. But over the past couple of weeks, it really has been growth that's been leading this market higher. So we've seen a resumption of the growth names coming back into play. Apple, Microsoft, Alphabet has certainly helped this particular theme. And the question is whether or not growth can continue to lead this market rally. When we look at some of the sectors, we'll see that we're not quite there yet, which is some of the concerns that I generally have with the overall health of the market rally. We do see commodities pulling back below the 50-day moving average last week. It's just gotten back to that 50-day moving average. This, from my perspective, provides a little bit of a buying opportunity for commodities, whether it's safe haven assets or like gold or oil. We've seen a bit of an escalation in terms of the conflict in Israel. That's led to a little bit of buying for these commodities. So the fact that commodities have pulled back the last couple of weeks as a result of a little bit of calm and stability in the markets, have provided a new buying opportunity for some of these assets over the past couple of weeks. One of the big buy signals that we've gotten is really coming from the bond markets. We've seen high yield corporate bonds actually trade back near a 52-week high. It actually printed a new 52-week high on Friday. And as of yesterday, it kind of continued to trade above those 52-week high levels. So this is the bond market, the riskier end of the bond market, providing us, a risk-on signal, a buy signal overall. That's been a bit supportive here for equities. We'll see whether or not this can continue. We'll see if this momentum can continue. So far, we've gotten that gap higher to that new 52-week high. Not quite enough evidence that this is sustained in terms of this bullishness. So we'll continue to monitor this over the next couple of weeks to see if the riskier end of the bond market continues to provide that buy signal or not. We had this pretty significant round trip in terms of the VIX from 13.5 about a month ago, all the way up to 21 and back now to 13.5. So this really reflects the equity investors' mindset over the next 30 days. Expectations for volatility over the next 30 days remains fairly muted. And this is something that we have to take into consideration in terms of equity investors at the moment are not particularly fearful. This is something to be considered. If you are in the camp that you believe that this is an opportunity for buyers, whether that's to hedge your downside risk or to, buy some upside from here. Both of those are opportunities because the VIX have kind of declined pretty significantly in terms of expected future volatility. The 10-year yield continues to grind lower here to that below 4.5%. We saw that rate increase on the back of the higher than expected inflation print all the way up to that 4.7, but now that's eased a little bit back into that 4.4, 4.5 level as, like I said last week, Chairman Powell took the option of raising rates off the table. Markets were a little bit concerned about that. And the fact that that's been kind of, that option has been taken off the table has certainly helped equity markets at the moment. If we look at bonds, we broke below that $91 level. But after trading lower, it's kind of trading back to that $91 level. And this is an important level for us to pay attention to. Do bonds break back above this level, or it starts to trade lower from here? We're about to start testing these levels over the next couple of trading sessions. So really important to pay attention to that. The dollar index, testing this 105 support level here right now after breaking out higher. With yields kind of continue to grind lower, my expectation is that the dollar index will likely break below this 105 level and kind of go back into this trading range between 102.5 and 105. We'll see kind of how that plays out here over the next couple of days. Gold, this is the one that I do think is worth paying attention to. We talked about the fact that we broke out above this 2150 level a couple of months ago, traded all the way up to 2450, and now we've pulled back to about 2275. And I think the pullback is now deep enough where buyers have now started to step back in terms of gold and paying attention to whether this is a potential opportunity as a buyer now for some of these safe haven assets, especially as the conflict in the Middle East is by no means resolved. And I think there's still going to be demand for some of these haven assets. And the pullback here, I think, is an opportunity as a buyer for gold. Same thing here for oil. We've seen oil kind of stabilize a little bit around the $78 level here. And the question is whether we start to see a little bit of buying now for some of these oil assets as a result of the conflict in the Middle East seemingly escalating again. So the fact that we've pulled back all the way from 88 to 78 presents a buying opportunity now for oil. So that's energy stocks, oil itself, all fall into that particular category. And then looking at specific sectors. So this is really where, when we look at technology, technology has led this market rally. But over the past few months, it really has continued to, the relative performance of technology remains poor. And what we have not quite seen is technology regain this 50-day moving average. And that's really one of the concerns that I have with the health of this market rally is the fact that the leading sectors of this market rally is no longer holding that leadership. You see it across technology, and you also see it across discretionary. Discretionary is just barely getting back above that 50-day moving average. But as you can see, the relative performance of discretionary remains incredibly poor. So, the fact that these sectors, these two sectors, are not leading the markets higher is some of the concerns that I have around the overall market. You have communications that remains quite strong here at the moment. Um, this is one of the sectors that continues to lead and continues to lead higher here. But the fact that technology and discretionary have not joined this party is concerning for me. Financials have kind of fallen back behind. Consumer staples at the moment is actually one of the stronger sectors. As you can see, it kind of remained above the 50-day moving average this entire time. But consumer staples also at the moment still remains below the 76.5 double top level. As long as it stays below that level, I would say we're still neutral. We really need to see a breakout above 76.5 for consumer staples to continue that overall trend. Healthcare remains fairly weak here, as you can see, nowhere near regaining the 50-day moving average. This is a sector that is at risk of rolling over and moving lower if markets kind of fail at these levels. I expect healthcare will be one of the sectors that does lead the markets lower here. Materials and industrials showing some strength here, have lost that leadership over the past couple of months. As you can see, materials have not really gained that 50-day moving average. Industrials, while regaining that 50-day moving average, have no longer continued to outperform the overall markets. And real estate and utilities real estate looks fairly weak, and energy has kind of fallen off a cliff in terms of relative performance. Now we can potentially see this start outperforming if oil starts to find that stability around 78. And this is actually one of the sectors that I do at the moment like as a result of the potential for oil. We've had a pretty significant pullback here to the 50-day moving average. It's held that as support, and I think this is a buying opportunity for some of oil energy names as a result of what we've seen in the Middle East. And utilities, by far the strongest sector right now, as you can see, well above the 50-day moving average, breaking out to new 52-week highs over the past couple of trading sessions and continuing that overall strength. So utilities, not the sector that you think leading this market higher, is showing that strength here at the moment. Home builders continue to be fairly strong here in terms of home builders as a result of housing inventory at all-time lows. With mortgage rates approaching 8%, you have a lot of buyers that have 3.5% mortgages that are stuck in their houses, meaning if they sell, they can't afford a new mortgage, so they can't sell their existing house. That's constrained supply significantly. That's one of the downsides. So I would say 30-year fixed mortgages, United States being one of the few countries that offer that, is the fact that it is constricting inventory significantly. And that's, at the moment, a tailwind for home builders. Home builders have seen fairly strong relative performance, fairly strong absolute performance, and regaining that 50-day moving average. My expectation is that we will make a crack at that 112.5 double top here and potentially move higher from there. And one sector that is also concerning to me is the fact that semiconductors, the sector that arguably led this rally from February of last year, has not really gained that 50-day moving average again. So lack of leadership from semis is concerning to me that is not driving this market higher, is not fueling the rally that we would like the equity markets to be on. You know, when you don't see leadership continue to lead anymore, the question is whether what can continue to drive this markets higher. And I think that's part of why, at least for now, my views here on the overall markets have shifted to being much more neutral. Unless we can break back above 52-week highs and we see technology, we see discretionary, we see semiconductors lead again. You know, my views here on the overall markets tend to be a bit more on the neutral side of things. So leaving you with a few different ideas for today. First one I want to take a look at is Northrop Grumman, defense stock in this type of market environment. We've seen Northrop Grumman pull back to this 465 level here, fairly range bound, but over the past few months, we've seen Northrop Grumman continue to make a series of higher highs and higher lows. So the fact that we've pulled back to this 465 level, I think is a buying opportunity right now for defense stocks at the moment, like Northrop Grumman. The other one we talked about here is GLD, gold. I talked about the fact that gold have pulled back to a level that I think is an opportunity as a buying opportunity. You know, we've got that rally from 197.5 to 225, pulled back roughly 50% of that. And I think now you have that buying opportunity on safe haven assets like gold. Another one is Ulta Beauty. We've seen now Ulta Beauty is a counter trend idea, meaning we're trading against the trend. And a lot of people, you know, may be uneasy about trading against the trend. And a lot of people will tell me, you know, that's very risky to trade against the trend. But from my perspective, you know, when you think about counter trend opportunities, this is actually where your risk is the least amount at risk, because what you're trying to do is you're trying to capture the very beginnings of the turn from a bearish to a bullish trend. And the earlier you can capture that trend, the less risk you're actually taking. What do I mean by that? Meaning, if the upside here, in terms of if this starts to turn around, is maybe, let's just call it, it refills, let's be very conservative. Let's say it just gets back to this breakdown here around that 470 level. It's currently trading at 394. You know, that represents, you know, an upside potential of, let's call it $80. Yet, what would be my downside on a trade like this, right? From my perspective, even if it just makes a new low, I would say my thesis is incorrect and it's time to get out. So if you look at the risk reward on that, you know, I could easily risk no more than, let's say, $10 as a downside in exchange for roughly $80 in potential upside on a very conservative trade. So what I'm trying to identify is, when has a trend reached an extreme and is at risk of reversing back into the other direction and going to head back up, right? What we're trying to identify are turning points like this and turning points like that. So one of the things that we do is we look for things like negative divergence, lower lows in price that are no longer being confirmed by lower lows in momentum. Those are some signs that sellers have been exhausted and buyers are about to step back in. And vice versa, when you get higher highs in price, but no longer getting higher highs in momentum, that tells me that buyers are getting exhausted and sellers can step in. And that's exactly what we're starting to see here now. Lower lows in terms of price, no longer being confirmed by lower lows in terms of momentum. It doesn't mean that this is going to be the turning point, but it gives you a higher probability of that happening. And if you're able to capture that turn at the very early, very early innings of the turn, you're actually getting this at the lowest possible risk reward, or rather, the most favorable risk reward possible. The earlier you're able to identify the turn in that overall trend. So when we talk about counter trend ideas, that's really what we're trying to capture, and Ulta Beauty kind of fits into that category. Next one I want to take a look at is Carvana. Carvana was a $5 stock last year, is now $122 stock. This stock has really had pretty significant turnaround considering it was a stock that was, in the bankruptcy bin about a year ago. So the fact that it's now a $122 stock, it trades at some of the most ridiculous valuations I've seen in terms of a company. And we've got that same higher high in price no longer being confirmed by higher highs in terms of momentum, showing us that's a potential of a reversal here on Carvana. And lastly, Accenture. Um, Accenture has recently pulled back fairly significantly, where we made a lower low in terms of price, no longer being confirmed by a lower low in terms of momentum. We've already had a few days of this trend starting to reverse higher here. So, this is really where the upside, like I said, is probably around that 345 level initially, and the downside here is just below 300 or so, call it 295 to be conservative. It's currently trading at 306. So that's roughly, in this particular case, $10 of downside in exchange for roughly $40 of upside. So you have a conservative risk reward ratio of about 4-1 on a trade like this. So these counter trend ideas, while seemingly quote unquote risky, is actually where you find the most favorable risk to reward opportunities in the market. So what we're trying to do here when we find these opportunities is align technicals with fundamentals. So both Accenture, Carvana, and the opportunity that we just found in Ulta Beauty. These are all ones where we feel that the technical picture aligns with the fundamental picture when we're looking for these types of opportunities for you. And lastly, Blackstone. This is a stock that has started to underperform in terms of financials. As you can see, even though Blackstone is still trading in this range, right between this 117.5 and 132.5, what you see is that the relative performance is quite poor. We've actually made a new low as a relative performance to the S&P 500 going back to the end of last year. So what this tells me is that even though the price at the moment is still trading in this particular range, the fact that the relative performance is so poor gives me a higher probability that this breaks the support level and starts to see some significant moves here to the downside. You see momentum has turned negative here for the past few weeks. And this leads me to believe that this could potentially crack that support level and start to move lower here in this private equity play. And the last opportunity I'll leave you with is with Baidu. This is I would say, an AI play. Baidu is the leading large language model here in the US with about 200 million users. They've doubled their user base in the last 6 months. Yet Baidu trades at 11 times forward earnings. That's about half the valuation of what the S&P 500 is trading at. There's no other AI stock in the S&P 500 that trades below the average valuation of the S&P 500. Baidu is expecting to grow fairly modest, I would say 10% in terms of earnings, 12% in terms of revenue. So it's not the 20-30% that some other AI stocks might be commanding, but the fact that it trades at half the valuation of the S&P 500 is pretty interesting, especially given the fact that it's a pretty profitable company. Net margins of 15%, operating margins of about 20%. And from a technical perspective, you have this nearly 1 year underperformance that have just now broken out here to the upside. So from a technical perspective, we're starting to see some outperformance here relative to the S&P 500. As you can see, underperforming the S&P 500, starting to see some early signs of outperformance. And that's exactly what we're trying to capture, is some early signs of outperformance to see if this is really where the market starts to pay attention to here right now. It's hard to know exactly when markets start to pay attention to specific stocks or specific themes, but that outperformance picture is an early indicator of potential starts of that. And that's exactly what we're seeing here from Baidu. So with that covers what I wanted to share with you here today. Like I said, the overall markets have looked a lot more favorable here over the past week or so as kind of Chairman Powell took the risks of raising interest rates off the table, but not everything is quite back to normal yet. The market cap indices have reclaimed the 50-day moving average, but the equal weight indices have not. And the sectors that have led this market higher, technology, discretionary, semiconductors, have not quite shown that leadership yet. Until they do, I'm not quite ready to call a bullish market just yet. In the meantime, I'm a little bit more neutral, a little bit more cautious, on especially on long positions that are profitable. These are some of the times to start taking some of those profits, until we can reestablish a more bullish thesis here in the overall markets. So we'll keep you updated every single week as to kind of how things develop, but hopefully this gives you a good sense for how we're thinking from the big picture, as well as some ideas for the week. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.